the leading partners at PitchDrive, one of the most active early stage seed funds in Belgium. But Boris, not only PitchDrive doesn't only invest in Belgian companies, but they are very active on a European level as well. So, Boris, the floor is yours. Go ahead. And let's give him a round of applause as well.
Yes. Everybody can hear me? Yes? Perfect. All right. Yeah, so there is a reserve. Okay, let's do that. Okay, so my name is Boris. I'm working today PitchDrive. It's been my life project. Not going to tell that much about PitchDrive, but I think it's a bit a common theme that you will see. As also a common theme in my my own, let's say, professional life. It started with my brother playing around. I think he just gave today in the TED also. We were already doing business when we were very young. And in fact, the common theme is that every company where I was involved in was acquired by another company. So I think I know a little bit about exits, learned a lot, made extremely a lot of mistakes. Starting everything at internet exits, people don't know, but I'm really there of the modem, the first internet provider, which was a spin-off from the KLL. PitchDrive, very interesting company because there everything exploded. It all started, acquired, then mobile IoT company that's today in the Trimble group. Then with my brother, the craziness of social media revolution. And then in 2011, I started my own SaaS company when they were moving into dating, later acquired by ELT and the guys from Tinder. I was already moving into my own company together with Wim and later Koen. We started, in fact, Expenditure Riding, which was acquired by Sodexo, and today PitchDrive, very short. We are only entrepreneurs, so 100% private. Jonas Danes is one of our co-founders also, or one of our biggest investors. And we are only entrepreneurs, so we invest in, also the people that mentor need to be done an exit or build a company. We have about 55 startups today in portfolio. I think the last 3 months we did another 8. So we do it at a space which is not really Belgium, no. But not only in Belgium, a lot, UK, Berlin, also Turkey we did one, and we try to move the borders later on that more. I'm going to discuss a little bit about, the common methods. I think it's important to understand the use, but also the abuse of some terms, like, for example, multiples and so on. Also the PitchDrive method, so how we are looking to a startup, I think it's interesting. I give you some insights in that. Then the huge difference between raising capital, multiples, and exiting. What we see is that is a lot of times really not used well. I think they're even wrong used. And then something extra, it's normally only I give this information on my LP and startup event, which is in Winter Circus the 5th of November. But I want to give you already the sneak peek on it because I think it's super interesting insight in valuations linked to the US and Europe and the huge opportunities we have there, also as European companies, in particular Belgium. Now, it's already asked, but I really want to see, raise the hands, who here from the entrepreneurs know the exact or know a valuation of his company? I think we're here, maybe I think we're at 20, 30%, 20% of the people here. Now, you're not alone. What we see is a recent study for, it was in September by Marketing. 40% of the SMEs don't know are unaware of the value of their business. But also what we see is that 72% thinks it will increase. Now it's very strange, you don't know, and it will increase. So I think from a strategic point of view, you need to know your valuation, even if it's like based on competition, based on other information, based on discussions with your co-founders, but you need to understand it. Because it really helps you on your building your strategy, your strategic moves. Sometimes you can do small acquisitions. I saw that also, even with the times of 2, with my brother, we were discussing it. So he did some small acquisitions that we even never mentioned, but they were impactful also on the growth of 2 at that time. And sometimes you don't know, you're bigger than others, and maybe sometimes those strategic moves come along. First method, very short, I want to go through it. I think the Burgers method is a very easy method. It's for companies who are very young. It's a method where you're talking 500,000 per bucket, and you say, look, there is a good idea, there is good management, there is good founders, even second-time founders, strategic partnerships are in place, and there is maybe already a product. And per bucket, you do 500K, and there is a valuation of 2.5 million. This is a very easy, this is for extreme early stage, it's ID phase, it's the guys who just started with 5 in a room. But it's a method, and I think it brings already something on how you can think about startups. Then the revenue multiple method. Revenue multiple method, everybody talks about it. For me, it's interesting, it's extremely easy to do. Valuation is revenue times your multiple the last year. Nice. But you have to really distinguish a lot here. You have to look to which business are we in. Are we in SaaS? Recurring revenue? Yes. Bingo, we can do very nice multiples, 5 to 10. Of course, this can be more. I think you already saw in the headlines that always those multiples are much higher. But in a normal SaaS company today, these are the multiples. E-commerce, it's lower, less recurring, 2 to 5. And if you go to hardware, it's even 1 to 3. Very simple to calculate. For me, the con is it's oversimplified and it's even not used well. For example, one of the things is you see exits, and then they say, we have an exit here of this amount, and then we're going to put the revenues that company had, and that's my multiple. No, in fact, I think it's even wrong to use it the multiples because they're so crazy and that were even not relevant for the buyer. I will come back on that later. I think linked to the multiples, and an interesting one, also what we do as fund, is that once you go later stage, you go into what we call the comps. You're going into your competition. You look to your competition. I think as founders, you need to use this more and do this more. I'll come back on that also a bit more in detail, what you can do there. But it's very, very important you do that. You look to comparable transactions. You calculate key metrics, revenue growth, you look into it. The pro is, it's really, it's based on the market. You look to the market, what can it be? It can be publicly traded companies. It can be also private transactions from your competitors. So that's interesting. It's already better than just a multiple, but it can be very challenging. Super challenging, mainly because, what are we going to look into? Are we going a private? It's impossible to look to a private, to an IPO, a company that's an IPO, or is publicly traded than a startup. But it helps a little bit on, for example, cybersecurity company, e-commerce company, B2C, B2B SaaS, AI, no AI, and so on. So it helps you on that. I think it needs to be also done. We are doing it mainly for, as we follow on rounds, we're doing it. Then the venture capital method. Now this is a method where in fact we're all looking to potential. What is the potential of the startup? There are some things like, is there some revenue growth? A big one is traction, churn. They're looking to competition. They put in fact some assumptions together. They put some comparisons together, and then they mingle it with their experience, and in our case, a lot of data. To give you an idea, at PitchDrive, 85% of the incoming decks we're not touching. So it means data gives us the first selection because we get massive inflow. We have about 20 decks per day we're receiving, which makes it almost impossible that humans, we have a team of 6 core people, 6, 7. There are a lot of automation. It was already the start of PitchDrive. There is a lot of automation into that. But it's an important one to look to where it is. I think a very important one is the team. How is the team compared in second-time founders as well? Pro, it's always looking to potential. It looks at the future. The con is it can be extremely subjective, and it can be also in particular cases there can be FOMO. Oh, fuck that company go there. That we go. Oh, this VC went in. This business angel went in, and there is a sort of FOMO, and things can go very subjective and not rational. Then I want to explain the discounted cash flow. I think this is interesting for a later stage for companies who are in private equity. This is interesting when there is more, for companies that really making already cash. So, and it's also projecting the future. So you put the next 5 years, what you project on cash, or positive cash flow in, then you do there a sort of discount on to do the value of money, and to adjust that, and then you have a sort of calculating total value. It's interesting. It's intrinsic value. It's really like it's much more tangible because this money comes in. I'm not burning anymore, and this and that. But it really requires a lot of forecasting and assumptions, and it's only working for profitable companies. Now I can say you, this is PE level. This is what private equity players do, NHG Capital, and they're looking to that. Now, if you sell, those guys have armies that look into data. They look into your Excels, your projections, and so on. This is another ball game. They're extremely good in that. For example, at PitchDrive, this early stage is more good into that early stage, into looking what will those crazy founders do, and what will they create one day. So 2 different métiers, let's say. Now, very quick, what is the valuation checklist? It's about what you need to do to know to do your valuation. It's the team and the management you need to check. What is the company performance? Do you have revenue growth? I will come back also on churn and revenue growth, because churn is extremely important. It's exponential. If your churn is 1% per month, it's 12% per year. You need to grow already 12% per year, and so on. So, and then if it's 2, 3, 4, it goes very fast. Stage of development. We are talking seed A, market conditions. How is the market going? Are we in climate? Are there new trends, ESG, and so on? Competitive landscape. How many people? Is it a red ocean, a blue ocean? Are we maybe in a red ocean? It can be very interesting to go in. It doesn't mean there is no place. And then IP. For me, IP is interesting, but sorry, most of the softwares you cannot have IP, and if you have IP, it's not always a major asset, but in some cases it's biotech and so on. It's of course very important. Here is a very clear, a very easy scorecard. The scorecards of PitchDrive, we do that at the end when a startup is very far into our funnel. We do a scorecard, but this is a very simple one. It's much more detailed. But anyhow, it's good to do that, to do last checks on the startup we're going to invest in. Now the PitchDrive method. I think a very important one. For us, CLAs, safe notes, in fact, it's crazy, okay? You can do it, it's interesting. If we do, we sometimes sign it, because people want to extend they want to wait with their valuation. But there is always a valuation. And what we say is, in fact, your valuation is linked to the illusion of the founders. You never take more than 20% of founders, never. We will never sign it, even if it's the most crazy company. If you take more than that, also in the earliest stages, per round, you cannot follow anymore. So what we say is, you want $1 million? You get $1 million, and then the pre-money is already $4 million. You want 500,000? It's $2 million. And then you can look into like maximum. Sometimes it's a bit less based on that, but that's how we look to it. Remember, the more money, the higher the expectations. You want your million, you want 10 million, you want 20 million, all good. You will see later how VCs think, what they will add in the terms. So for me, I never understood, we're going to wait, because we don't know the valuation yet. You go then later in the deck, in every CLA, in every safe note, there is something like, and if we don't agree and if there are no rounds, then the valuation will be that. So even in uncapped, there is a valuation. So there is always a valuation. And that's something that is really misunderstood. And we are fighting against that. Also sometimes when I see cap tables first round already took like 35, 40% from founders, it's crazy. It's totally crazy. For me, it's even, I think it's even criminal to do it, because everything is, the whole follow-on is super difficult to do there, mainly in the early stage. Of course, over the years, they will dilute more, but it's just that in the beginning and in the first stages, it's a very important one. So that's how we look into it. How is PitchDrive also looking? In fact, very open. We look to a company, it needs to be an X24. That's our model. We don't need, because there was a very interesting one of Khan talking about the power law and so on. We say fuck power law. We don't believe in it. And I think I understand when you're Excel, when you're like the best members of this world with hundreds and billions of finance, you need it. You need them. Mathematically, yes, they're fully right. I would also go on power law. When you go early, you don't need power law. You work more on multiples. You make sure that you have some very good, decent startups you can exit. Not the billion, because now we have one where, for example, we're talking to Axel, where we have one where Bessemer is in. Those guys, they don't think, like 7 years ago it was unicorn, 4 or 5 years ago it was, it needs to be $4 billion company. Now everybody talks about it needs to be a decacorn. So, okay, you're already at the 10 billion. So this is also not our business. Our business is we create sustainable companies. And if we have, for some reason, the luck to be a unicorn, it's a cherry, it's interesting, but it's not our thing. Also, we look to runway. You need to have 18 months. A lot of companies, 12 months. No, you need to have 18 months runway at least. Founders need to good. Also, we try to co-invest, but we dare to do crazy things. Like, for example, we invested in self-driving trains, a company, Otif. It's a crazy thing to do because it's a bit risky. Thinking like we're gonna make that trains are driving, fully autonomous. But those guys doing it, super hard, it's extremely hard. I was there last week. They don't sleep. But you see, they're really changing the world. And of course, there need to be an outlook for 12 to 24 months where we, as PitchDrive, and with all the entrepreneurs, Jonas, Lawrence, all the people around us, can see, can we really have that impact? Now, for me, 3 important moments of valuation. First one is value investing. It's where value investing moment is very easy, low and high. It's very low in growth, and you're very predictable in growth. So what you see is low, for example, 10% per year, 50% per year. Nice. Take the balance sheets, take the EBITDA, whatever, you can calculate it. You have bookkeepers can do that, accountants, go to the big 4, they can perfectly make that for you, what is there. It's very easy to do. Now, where we are looking more in is the venture investing moment. That's where you have high growth, but very unpredictable. You have like quarters where it's going well, quarters less, competition coming, AI makes the whole thing completely different. This is where we are in. And there it's more about intangible assets like churn and growth. It's about how are those founders, are they second-time engineers, salespeople? How are salespeople? Is there something there that makes a difference? And also some network effects. At the end, it's all about risk mitigation, what we do. We look to, with these guys, crazy guys, will we go to the next mile? Are they changing the world? And then the company exit. That can be very interesting because then you're high, that the moment you're growing, you're at the high pace and you're very predictable in your growth, start thinking about a possible exit. Because remember, good companies are always bought and not sold. I think it's a very important one. The moment you start selling your company, you're already losing a lot. You need to be bought. And that's, I think, a very important one. Also, it's the managing that momentum. I will give 2 examples later of my own company we sold and also one of our portfolio companies, Henchman. As an example. One, value investing, it's calculation, it's balance sheeting, yes, it's interesting, but if you're there, please, for a tech company, it's obsolete. You need to work on more intangible, creative, continuous things. You need to work on that. It's about brand reputation, it's about your traction, your potential, also story. What's your story? We ask it a lot. How many companies that are bought by a story? But you need to be storyteller with, of course, a very honest and story, which also has a purpose. This needs to be there. And if you have that, that's all part of your assets and part of your valuation. And then you create a sort of right momentum. Now, When you're raising with VC, so when you're in that venture investing, runway, traction is important. Because some people, yeah, we have still 3 months. No, you need to start doing, you need to start doing it much earlier. What's your traction? Some people are like, we're going to raise now 5 million, but yeah, what's your month-over-month growth? Yeah, you need to have that traction to show really when you go really big. Market, maybe it's better to wait, and also speed of execution. Now, a third one, and I really want to talk to all founders here, it's really your duty to discuss every year with your co-founders a valuation and exit strategy. It can be like one line, it can be a talk, it can be on, in a pub, with some beers in a pub, can be whatever, but you need to discuss it. Why? Because you need to know what other players are doing. And you know, it's even, when I'm in boards, I say you need to know it. It's very easy. Go to PitchBook, you know everything. It's like 2-3 queries and you know it. You have Crunchbase, you have all the data. Look to your US guys, they're 2 years ahead, data is there, use it. So you know already that. Second, internal, your professional and personal financial goals. What we see is, for some people, is 10 million euro on their private bank account is a life changer. Fuck, I have 10 million, I'm fucking rich. Others say, 10 million, not interested, I want to build a Unilever. So, purpose can be different, personal assumptions, aspirations can be different. Make sure there is no discord there. Linked to that, also manage your investor relations well, because a fund can be they can have several things, understand what your investors want, what they expect. Also, look to your timing. When you're in that exercise, where are we? What is coming? We know ESG is coming. We know a lot of other things are coming. You need to understand it. You need to look into that. You need to make time for that. Not in the office, somewhere else with your co-founders, make some time for it. Because sometimes it can be like, fuck, we have now 3 months, maybe we have to sell. Or there is this next year, or the next years, 2 years, there is a consolidation wave. Maybe we need to be part of that, or not. Maybe we need to start to do a small acquisition somewhere, because we know by our data that there is somebody having trouble. Why not? Go eat, sleep with your devil. It means sleep with the devil. It means like go with your competitors. It's very important. Go for dinner, eat that. We did that also. For example, Mobile Expense at that time was our competitor here. We had talks with them. You need to do that. There is nothing wrong with that. Another one is understand also the impact and the team culture. Come back on that. For me, I think an entrepreneur can have 10 years. I think a startup, to keep the craziness that you expect from your team and from yourself, there is a conservation date. It's 10 years. Look to almost everybody, it's always 10 years. Look to even Jurgen Klopp of Liverpool. The guy has more energy than I don't know, but he also is doing something else. He's just now signed, doing a complete something else. He will do the Red Bull team's managing. But it's super important. You cannot keep on having that same energy, so you need to do something else. But also understand that with your team will go over time. So sometimes bringing in a new merger can be a very interesting one to reinvent yourself. Now, in fact, the best valuation method, it's no method. There is no valuation. There is no method. Nobody's using a method. It's about a strategic investment. They want to have an M&A. They want to just merge an acquisition. It's like an investment we want you. That's where you want to be. Talking about my own company, expenditure, we were not in an exit mode, totally not. We were raising around 20 million. I will show you how difficult it was, because it was a lot of sweat there. But we had the SaaS expense management startup, 10,000 B2B customers in 32 countries. One of them is McKinsey Global. We had Deloitte in a lot of countries, a lot of the Big Four, a lot of the big companies. I was surrounded by only entrepreneurs. So Jonas was my board, Lawrence. In fact, all the people from PitchDrive today are all my shareholders are there, or in PitchDrive also, or part of the GP, or part of the company. Because we did crazy shit together. I was surrounded by them. It really helped me also to do that. And then we had talks, strategic partnership talks. Interesting, you're looking to expense management, and then Sodexo came in and you start talking, and it's a minority stake, and a couple of months later we're acquired. We have an acquisition proposal. But there, it's not driven by there was never a multiple on the table. It's all about, we want you because you're the best company. They wanted to have setting up a business line, and they saw 100 companies and they wanted us. Now, they didn't want us only because we had a very nice growth, 15-20% month over month. We had a nice team, we had a super culture, we were doing really well as a SaaS company. We had negative churn, this and that. No, they said, yeah, we're mainly interested in your sales machine. And of course, we had an extreme big sales machine, sales engine, which was predictable. But we didn't see it as a main asset. Now, that was our main asset, and that was the reason I really wanted to buy. So, of course, the rest is also, of course, let's say, a product of that. And we also used that momentum from the race to say, look, you want to buy us? I remember that my partner went to the blackboard, put a number on. We said, like, okay, if they buy it, that's okay. We went out, and 2 days later they said, okay, we want to buy it for that price, okay? So we also we discussed it also with our shareholders, and then then you sell because the multiples are so crazy, but you don't think in multiples anymore. You also think like, can we do that over that longer period? Then you need to do it. Now I had a lot of learnings. I completely underestimated, for example, our 5 million round. I remember we were growing 10-15%. I remember I said to a board, like, oh, we're gonna do it, Wim, very easy. We have this all in. No, this was so damn difficult. Going to the notions of this world, this and that. In the UK, it was sweat to have it. Then once we have that term sheet, everybody was ready. And we had one billionaire, $8 billion guy, he's the owner of, today the owner of Starling Bank. He's a hedge fund guy. He said, you get 5 million, no veto, nothing. I just want a board seat, no liquidation preference. You get 5 million now. Of course, he was driving all the rest out. This is what we call a super angel. He just took it. He did a very good deal, of course, later. But it's just to understand, a normal VC cannot always do that when you are like old style working. So that was my big learning there. Also, keep your eyes on the core metrics. It's also something. It's new ARR, keeping your churn down, having that. It's super important while you're also raising. Also, our learning is that we were first a prepaid card, and then we pivoted to a SaaS product. Now that prepaid card, we had Bridgestone, we had mobile Vikings as customer. We made nice revenues, a couple of million. It was running quite well. But in fact, I think that the learning is also a pivot. Can bring you from good to great. A pivot today is always called, it's not going well, so we're going to pivot. Think also that you are going to pivot when you're doing even good. Because we saw also the team was much better in B2B, also with Koen, our product guy, he was very into that. We made that really the difference. Buyer expect you to stay, so we also had to stay 3 years. That was also something I underestimated. Big company. Happy I did it because I saw like 300,000 people company, never saw that, learned complete all the logic how they think. But for some reason, it really helped me to understand also how that works, because it's still fibroblasting. If I look back to how we were, we stayed there. Then of course Corona came. Also that can happen. You have a runout and then you need to renegotiate whatever. So it can have really an impact if you don't are always in control. And then I think managing company cultures also there to wall to the face. I thought like we were acquired at the same time. There was a Polish company. They then brought it together, and I thought it was much easier. Now I have to say. This was extremely difficult. In fact, my learning is if you merge, you need to have professionals around you that understand how merging works, how team cultures work. We had a party culture, but I can say that the Polish had also a party culture, but it was a different one. So, these things, you think it's so easy, but it was very, very heavy. Look, if you see what a machine that Jonas built, to acquire companies, it's a machine. He has professionals that help, that integrate those companies. You know, if we had that, it was much easier. Having people like that, it would be much better. So, but that's a learning there. The henchman case, I think Jorn is here, one of the founders. I think everybody's asking always about questions about henchmen. I think why I want to bring henchmen is because it's very interesting what I said. Those guys, they already discussed the exit to me when we invested the first time. They said we're going to build a 100 million company in 5 years. Watch us. So they already discussed that. So they already were even, you know, it was even not going on. They already had that. Now, why